Okay, good Monday afternoon to you. So I hope you had a great Thanksgiving. In this tutorial, I'm going to talk to you about 10 things, location, when you're getting ready to invest in a multifamily asset. It's been said location, location, location. Okay, let's dive deeper than that. Let's dig into that. Let's find out what that really means. Doesn't always mean are you sitting out there on the frontage road of where two major thoroughfares intersect, although that's nice. So number one is jobs. Hey, Rommel, how are you? Jobs. So what about jobs? Job growth, job stability. What new jobs are coming in? What new jobs are leaving? What is the personality of the jobs? Meaning, are you investing in a tech-centered area, in an industrial-centered area, in a medical environment-centered area, and like a corporate or banking area? And what are the prospects of jobs in those particular industries and in that particular area in which you're going to invest? Jobs, job growth. Now, here's a key indicator here. And I'm going to say this is pretty much true through all of the 10 things that I'm going to discuss, and that is don't evaluate based on just what you see today. So take an average of the last 3 years and what the projections are for the upcoming 3 years. 3 to 5 years before, 3 to 5 years post-purchase. And then you'll get a more comprehensive personality of the area to which you are going to locate this investment, or the area in which you're going to make this investment of the asset. So jobs. What's been the job growth for the past 3 years? What's been the personality of jobs? And what's the projected job growth over the next 3 to 5 years as well? Population. Same thing. What's the population growth from the past 3 to 5 years? What is the expected population growth through the next 3 to 5 years? And what is the demographic projection of that population? So for example, when I'm going to talk about this in a minute, when a company comes in and they're, let's say, a tech company, and they announce they're going to move their headquarters to the city and they're going to bring a bunch of tech jobs. Well, they're going to bring a bunch more tech jobs, and other tech companies, and other tech companies are going to see that this is a viable environment in which to locate their business. So the personality of the jobs, in the market to which you're going to move makes a difference. Schools, the availability of schools. Now, if you're doing a value add property and you're buying a property, say, that was built in 2000 or 1990s, the schools are already there. They're established. They're founded. Probably not many new schools coming into the direct neighborhood in which you're going to buy your asset. However, other schools, other school growth, school district growth is very important. And another factor is, how are these schools performing? Like, how are they performing on the national average? Are they meeting national average expectations? And if so, then you've got some good schools, because people like to move to areas where their kids are going to go to decent schools. So pay attention to the schools. Companies. What companies are there? How many jobs do they provide? What is the projected stability of those companies? And what are the projections of other companies moving into the area in which you're going to invest? Let me give you an example. Number of years ago, maybe now 15 years ago, you can Google this. Toyota decided to announce that they were going to put a plant to build their Tundra trucks in South San Antonio area. Hey, Lawanda, how are you? With that announcement, they said that they would anticipate there was going to be 10,000 new jobs. I don't remember the exact numbers, but this is for an example. Okay, so they said there was going to be 10,000 new jobs. Well, with Toyota came a plethora of other companies, vendors that supported Toyota in their line of work, and with those companies came jobs, the anticipation of more jobs, hiring more employees. And all of that means they need places to live. And so pay attention to the number of companies that have come in over the past 3 to 5 years, the number of companies that have newly landed and the number of companies that are projected to come in, and also the sector that they are coming into. Why is that important? Well, like the tech sector, let's just say. Okay, if a tech sector company comes in, then they tend to attract more tech sector type companies. Same thing with medical. If medical companies come in and they build new hospitals and new medical facilities, that tends to encourage others to come in as well. And that goes to the stability of the job, the stability of the workforce, and the stability of their long-term ability to pay. And that's what you're looking for, is the stability in the workforce and potential renters. How about this? Number 5, growth of the city. Now, most major metropolitan areas are growing, period. But take a look over the last 3 to 5 years, or maybe even a little further. Take a look at the history of the growth of this city. Do you see just a steady incline, a steady incline? Take a look at the projections of the growth of the city over the next 3 to 5 years as well. And what that tells you oftentimes is it's a place where people want to live. It's an environment that has a decent quality of life, which means that's why people want to live there. It also can tell you that the city fathers, the city government, are friendly to inviting new residents into the city. And I'm going to talk about government friendliness here in a few minutes. So the growth of the city. Next, renter strength. Now, there are all kinds of websites available that will tell you the strength of the renter. What do I mean by that? What is the, I don't want to get ahead of myself. Okay. What is the average rent occupancy? What's the average occupancy in the apartment community? What's the average unit mix? What's the average square footage? And what is the average price per square foot that those apartments are getting? You get these numbers on average, and then you compare it to your subject property, and you see where the room is, where the value add is, how much you can raise rent, what kind of occupancy you can raise, and you can determine if your property will be self-sustaining based on those averages. Now, hopefully, you're going to put more renters in, a higher occupancy rate. You're going to charge a little bit more for rent, higher rent rate, and you're going to have a better product once you rehab it and once you add the value to it. And that'll increase your overall profitability. But I would say take a look at the averages. And if your property can sustain itself based on the averages, then that's a property you want to continue to look at. Climate. I mean, let's just face it. People like to live mostly in warm climates. If you're one of those that like to live in a cold climate, good on you, right? But the climate also indicates the amount of maintenance, the amount of upkeep that you're going to have to do on the property. So with climate, like the real cold climates, you have some things that you don't deal with down here in Texas or in Arizona or in Florida. You know, you don't have to have snow movers to clear out the parking lot. A lot of times there's not boilers that you have that break. And so the climate can be an indicator as to whether or not your projected asset is a good asset to buy. Hi, Rose, how are you? So pay attention to climate. Next, hospitals. So the availability of medical facilities is very important. And again, the projections of medical facilities growing in that area close to your asset is important. Those medical facilities need to be readily available. They also bring jobs, and they bring a certain element of stability to the community. Market averages. Now, I touched on this a little bit, but market averages. So take a look at the local apartment association, and they publish, even the National Apartment Association by region, they publish the average rent roll, the average rental price, the market rent, and the average occupancy. So let's just say that the average occupancy on an asset that you wish to purchase is 90, well, let's say in the market, it's 93%, okay? But your average occupancy on the asset you wish to purchase is 89. Okay, now you've got 4 points or 4 percentages points to get occupancy. Can you manage the property, deal with the property? Is the property self-sustaining at 93% in that example? Market averages. Also, length of stay by a tenant, very important. If you got a large turnover, people are coming and going, that says a couple of things about the property. Maybe it needs better marketing, maybe it needs some rehab, maybe it needs long-term contracts, something to help stop that turnover, because all the turnover just costs money. And finally, number 10 in this particular tutorial is what I call government interference. I hate even saying that. Government interference. It is a fact. It is a fact of life that the government plays a role in all of our assets, plays a role in all of our decisions for real estate investors. Now, I don't necessarily mean the federal government, although that is important, but what I mean is the local government in terms of the city zoning, planning, codes, municipalities, HOAs, neighborhood associations, all of those lower level municipal or governmental entities that can have an impact on your asset. If you plan on doing any kind of rehab or any kind of add-on or any kind of significant work to your asset, then you're going to have to deal with government authorities. How easy is it to deal with government authorities? Are they inviting business into their area? And if they're not inviting business into their area, why? And if they are inviting business into the area, that's a good thing. Simply ask. I found it to be very useful to visit the planning office, to visit the tax assessor's office, to visit the municipal offices, and just ask questions and find out what the climate is, what the overall climate is of government in that area. Okay, in review: jobs, population, schools, companies, company growth, the growth of the city, renter strength, the climate, and I mean the sun and the moon and the snow and the rain, hospitals, your market averages, which are available all over online, and government interference. You get a handle on those 10 things, and it gives you a really good snapshot of the asset that you're wanting to buy. Okay, as always, if any of you want help on your multifamily investing, evaluating deals, or getting a plan for your future, feel free to reach out to me. You can message me here, you can message me through Facebook, or you can get on my calendar, paulmontalongo.com/strategy, and you can book a time to speak with me. I'm happy to help each and every one of you. And if any of you want to invest with me in my deals, just let me know also. I hope that this tutorial has been helpful to you. Please share it, like it, comment on it, and I'm sure I will see you again in the very near future. Adios.